Hey everybody, it's Eric Vanny here, the realtor in Ottawa. I'm in Riverside South here, just south of Ottawa, and I've just been thinking about how our industry has changed so much in the last few years. I know my buddy Scott Hunter lives in this area there. He's a mortgage professional with Mortgage Brokers Ottawa, and so I wanted to pop by and ask him a few questions about mortgages. I think you might be interested in hearing what he has to say. So let's go knock on his door. Hey Scott!
Hey Eric!
How are you, man?
I'm doing great. Great to see you.
Hey, listen, I got a couple questions about mortgages. You want to take a second and we can chat about it?
Absolutely. Let's head around back here.
Awesome. Look at this pool.
Let's head on in here.
Oh man, Scott, this is great. We're sitting right by your pool. It's a beautiful June day. So I wanted to get into some questions that I have about mortgages. And you and I, we've known each other for a long time. I think the first deal we did was 2006.
Yep.
You were a bank employee at the time.
That's right.
Working for CIBC, and I was with Sutton in the East End. And you know, things have changed a lot in the last, well, especially in the last few years.
The pandemic has changed a lot of things in a lot of industries, and we are no different than anybody else. And really it's forced us to be that much more adaptive and dynamic and be ready in advance of those offers so that people can go into the buying process with confidence, knowing that they are going to get their financing once they find the right property. Right. The property really is the hardest part right now, and I feel for you because that's your job to make sure they find the right place. Yeah. And with the inventory shortage right now, very tough.
There's very little available.
It's crazy. So when they do find that property, and like you said, there's no more conditions. Those are a thing of the past now. So they need to make sure that they are properly vetted before they go into that process to know that they're going to be successful in securing financing, or they know exactly what they're going to be dealing with in advance of the financing. So there's no surprises for them when they do end up winning that bid for the property.
Right. And what exactly is a pre-approval? I mean, we use the term all the time, we toss it around, but exactly what is it?
So a pre-approval is a vetting by a mortgage broker, and what they're doing is they're basically doing an underwriting of their file to make sure that everything that they're telling you actually is factual, so that when all the documents actually have to get turned over to the lender and to the insurance company, that everything is going to appear as good as possible or as good as they say it's going to be. Right. And that way they'll know with confidence that this is going to work or this isn't going to work, or we need to make a couple of tweaks in it to make sure that it is successful in the end.
Mm-hmm. And so at this point, you're taking what they're giving you at face value. So it's really important, obviously, to be very honest with your mortgage representative.
Well, that absolutely. And if they're not honest, the documents will tell the story, right? Yeah. So they'll fill out the application. That'll be step one of the process. And then basically it's vetting all the different information within there. Whether it's the assets, the income obviously is huge. And they want to make sure that, you know, what we're presenting is an accurate picture of their situation. So yeah, definitely being accurate on the application is a very healthy start. Yeah. But then, even then, sometimes people feel they're being accurate, but they don't realize, okay, well, this is actually what it looks like on paper. And self-employment is a real big thing with that. Mm-hmm. People will often mistake what their income is versus what it says in their tax returns, and that's kind of what the lenders are looking for.
So often when people come to see me, the first step of the discussion is, how's your financing? Have you talked to a mortgage broker or your bank about how much you can afford? And often people are very reticent to get involved in this step, but it's really the crucial first step before we start driving around and checking out properties. So could you talk a little bit about that? Why is it so important to do the first step with you before we start shopping?
Putting myself in a buyer's shoes, I would want to make sure that all the properties that I'm visiting, I can actually afford. And just because I think I can afford it, I've gone online, I played with a little calculator, and I think, oh, I can afford $2,000 a month. I'm going to go see this. Well, the reality is, if you can't get approved for that, it doesn't really matter what you think you can afford. At the end of the day, you're relying on the bank and the insurance company to vet you to say, can you really afford this? And they may have a very different perspective than you have. Yeah. So knowing that you have gone to a professional before you have even begun your search will give you that extra degree of confidence, knowing that you're not wasting your time. You know what you're qualified for, you know what you're able to buy, and even something very simple like, well, I have a pre-approval for a $500,000 property. Well, what if it's a condo? And now you have condo fees of $750. All of a sudden that $500,000 pre-approval doesn't really work anymore because you've got extra fees that are going to be associated with your purchase. So all the little details that happen in the background can make a real big impact on things, and you can have as much heads up as you possibly can going into that situation. So there's going to be no surprises. The last thing you want is for there to be a surprise at the end. And often it's an ugly surprise and an unwelcome one. So the more you can get rid of all possible roadblocks and clear all that and have smooth sailing ahead, the better off you are.
One question that pops up sometimes when we're doing deals is, there is this, in the final step where you're getting the mortgage confirmation, the commitment from the lender.
Yep.
They are often doing an appraisal. Now, whether it's an appraisal from behind a desk in Toronto somewhere, or
Yep.
whether they're actually sending somebody here to Ottawa to look at the property. At that point, if there is a difference between the price that we're paying for the property and the assessed value from the perspective of the lender, that shortfall, can you talk a little bit about what happens at that point?
Well, things will change. If you've paid $900,000 for a property and the lender and insurance company appraiser only think it's worth $850,000, somebody's got to make up that difference, and that difference is going to be made up by the buyer. So they need to be prepared to change their financing. So all of a sudden, that 20% down payment that you thought you might have, well, maybe you're a little short now, and maybe you do need to have insurance on that mortgage, and you're not going to qualify for that because you need to come up with out-of-pocket cash to cover the difference. Especially in today's world, where you see bidding wars for property, you see it's being sold for way over list. There's a lot of that kind of jeopardy that we run into, and which makes it even more important to go see a mortgage professional before you begin that process, so that listen, how might this turn out in the end, and what can I truly afford here? And also, people's wants and needs are very important with mortgages. It's a very emotional process, and if they have something stuck in their mind and it doesn't end up happening, that can lead to disappointment, and you never want to have that, especially at the final stage of things. So in order to make sure that even if they are in a competitive situation where they do technically overpay for the property, they're prepared for that, and they know what's going to happen, and they know what their options are and what their possibilities are.
Gotcha. And is this something that you've seen a lot in the last couple of years?
Well, definitely more so in the last few years than ever before. So I would say it does happen frequently enough, and enough that it needs to be addressed, especially in different markets. There are some that are much more competitive than others, as you are well aware. So it's again important to talk to somebody beforehand to make sure you're ready to deal with this potential issue, and especially you can typically tell with the buyers, is this something that's going to be a possibility for them or not? Some people are like, we are not getting into a bidding war, we are never going to do that, and those people might not be in that situation. And you have some other people who've bid on 12 properties before and been unsuccessful and are tired of shopping around and don't really care if they overpay by $20,000 to get a $980,000 house. At that point, it's almost a rounding error for them. So they'll deal with the consequences of that. But as long as they know what they do at the end and how they manage that, they're much happier. And you want to have happy people at the end.
Absolutely.
Makes a much better experience for everybody.
Absolutely. I had one last year where the person's employment situation changed, but they neglected to inform their mortgage broker of it. And so they went from a permanent job to a job where they were on a probation period, and we ended up losing the deal after a lot of effort to try to land this property. We had it, and then it didn't end up going through.
And that's a great example. So somebody could be thinking, well, great, I'm making a good income now. I'm leaving my job, I'm going to go make a better income here. Well, all that makes sense. But all of a sudden you're on probation, and now the lender and insurance company doesn't like it as much, and you might not get approved. So little things like that might not be obvious to the average buyer will make a very big difference on the financing side of things. And if we can get out ahead of that beforehand, it makes all the difference in the world.
Great. And so at this point, when you're doing the pre-approval, like you're getting all these documents, you're verifying the statements. I'm guessing, statement of employment, you're getting, pay stubs and that kind of stuff. These are the details that you're verifying at this point?
Yeah, so every different job has a different level of due diligence that goes into it. So a government worker and a realtor would have two very different sets of criteria that they have to jump through because they get paid very differently. Okay. Self-employment versus regular employment, part-time employment, temporary. People are working contracts. You know, it's a very, we're in the gig economy now, and a lot of people don't have, you know, the standard jobs anymore. So it's even more important that they get everything properly vetted. I see people with income from 5-6 different sources, because that's how their life works, and we need to make sure that the lenders and insurance companies are going to be comfortable with that.
Mm-hmm. And then at this point, you're locking them in for a rate, right? Once you issue that pre-approval, usually I'll see it's a rate hold for 90 days or 120 days. What's the common period that you'll hold a rate for?
Well, so as a mortgage broker, I'm not the one holding the rate. It's going to be the lender. Every lender will have different criteria for rate holds, and some of them will be as short as 45 days, some of them will be as long as 120 days. It really depends on the lender and product that the customer is looking for.
Okay, and the rate hold, that goes to the closing date, or is that just to the date that you're doing the actual deal?
The rate hold will go as of the date of submission.
Okay.
So it's from submission date until what that agreed upon period is, and like I said, that depends on the lender and the product. So it's it's a little tricky balance, because especially when interest rates are going up, typically you want to have a longer rate hold, and maybe that isn't exactly the perfect product for you, but there's always a give and take with these situations, much like when you're buying a house.
And so I know, this is kind of the nitty gritty that I wanted to get into here with you, because a lot of times people are asking me these questions. I don't really have the answers for them. When you're submitting that deal, this is not when you're doing the pre-approval. You're talking about when you're submitting subsequently, when you're going for the actual mortgage commitment from the lender, right?
It gets resubmitted with all the accurate information, because things will change. Like a pre-approval will go in for, you know, $800,000. Well, they actually need 765, 300 in the end. Or they want to change their amortization or things like that. You know, you never know what the ultimate purchase price is, property taxes, condo fees. All those fine little details get ironed out later on.
Okay. And so, all right, now the person has their pre-approval, they're ready to go. Let's say we do get a deal conditional upon you getting that mortgage commitment. So that's the phase where you're going to submit everything over to the lender. Is that the point at which you're doing the credit history, or are you pulling the credit earlier than that?
The credit pull will happen when the pre-approval gets sent in.
Okay, and so the pre-approval, this is a question that I get often, is will this pulling the credit, will that affect my credit rating? This is a question I hear all the time.
So the answer is more no now than it ever has before. For this type of shopping around, this isn't something that the average consumer should worry about. If they're going out and doing 12 of these credit checks, going to different lenders and checking things out here, yes, that definitely can. And that's one of the advantages of going through a broker, is there's less credit pulls on you, because we're doing the credit pull and then submitting it with the file to the lender. So it's less of an impact on their credit than it would be the old-fashioned way, where they're going door-to-door shopping kind of thing.
Gotcha. Okay. And so they've got their pre-approval. We find them the place. Now let's get back to the last couple of years. We're doing the deal. The deal's firm. No conditions. You know, we get the deal. Monday morning comes around, I'm sending you the deal.
Yep.
You start sending it off, and now you're just sending it to the one lender that you had done the pre-approval with?
Well, that would depend on any changes. So obviously, like if their rates are much higher now, then we're going to be probably stuck dealing with that lender, because that's going to be the best rate. But at that point, we're basically starting from scratch, saying, hey, who's got the best deal for you? What do you want? What do you need? Who has the best deal for you right now for that particular product? And if it's better than what you have in the pre-approval, then we pivot and we go someplace else.
Gotcha. And you're with Mortgage Brokers Ottawa. So
Yep.
Mortgage Brokers Ottawa, I guess they have a department that handles establishing relations with all these different lenders. How does that work?
So Mortgage Brokers Ottawa is the biggest brokerage in Ottawa. And what that does is it allows us to get the best pricing on things. So think of it as kind of like Costco. So even though you might be getting a very large mortgage on your own, well, we're getting a lot of those through the whole company. We're doing over $2 billion a year in business, and that represents a lot of buying power. So lenders will give us preferential treatment and status because of that, and we'll have access to quicker turnaround times. We'll have access to cheaper pricing on things. It'll be more efficient and provide a better customer experience.
That's awesome. Advantage of going with an established outfit that's been in business for a long time.
Absolutely, a great reputation, and every year we're winning Consumers' Choice Awards, and it's nice to work for such a reputable company.
That's great. Scott, one of the things that's a little bit nebulous in most people's minds is how exactly you're choosing the specific lending products that you're offering your clients. And so I know there's a whole bunch of different criteria that you're looking at, and there's a whole bunch of different products and a ton of different lenders that you have access to. So how does that part work?
It is remarkably complicated. So one of the advantages of going with a broker is we have access to such a wide range of products and lenders. So right now I probably have 1,600 different products on the shelf.
Wow.
And not every product is a good fit for every buyer. So it has to be as well selected as possible so that it's a good fit now, it's a good fit 3 months after closing, and it's a good fit at the end of your term too. Because I always tell people the devil's in the detail with mortgages. It's all the fine print that ends up with people upset down the road. And if you are truly understanding that buyer when they're getting that mortgage, then you'll have a happy client, and a happy client will be a client for life, and that's what we're going for here. So it's really a big analysis of their financial situation, their wants, their needs, and then matching them up with the most consumer-friendly lender with the best rate possible at the time that they need their money. Because not all lenders are created equal, and not all products are created equal. So for instance, we could be sitting around the water cooler chatting at the office, and you say, oh, I got a 5-year fixed and I got a 5-year fixed, and they could be wildly different products. Some examples are, well, if you wanted to refinance your home, you wouldn't be able to. You can only get out of your mortgage if you sold your home. I could have way better prepayment privileges on my house than you have on yours. Our selection of how often you want to pay the mortgage can change quite a bit, whether the product is insured or not. Even like every 5% extra that people put down can qualify them for different pricing. And one of the very kind of interesting things in our industry is people think, well, I put down a big down payment, I should be able to get a better rate. And actually, oftentimes that's not true. The bigger the down payment, the less likely the bank is to give you the very best rate possible. And there's a lot of reasons for that. Like, for example, the less you put down, the client is going to need to have insurance on the property. Well, if they don't make their mortgage payments, the bank's not on the hook for that. They're insured. The mortgage is insured against default, so the bank is made whole. Whereas if you come in with your 20% down payment, if you don't pay that mortgage, then the bank is on the hook for that entire loan.
Very counterintuitive. When I first heard this, I thought,
absolutely right.
That's so weird,
You think, I've been really good. I've been very diligent. I've saved up all my money. Here you go. I'm coming in with the strength of a big down payment, and you end up hearing you didn't get as good of a rate as somebody who didn't save up as much money.
Yeah.
It's very strange. So having those conversations is sometimes a little eye-opening for people, but it's good that, again, that they do this in advance, and they're not caught off guard, and they can kind of weigh their pros and cons, which direction they want to go with their down payment strategy, their prepayment strategy. And the more they have time to think about this beforehand, it's not rushed at the end, and you do a better job, and you end up with a happier client in the end. Every client is a very individual situation. They're never exactly the same. Everybody has a different stage of life they're in. Some people have a couple little kids at home. They're going through daycare. The expenses are insane. They're in private school. They're in whatever. Well, they don't have that much money right now to put down for extra payments. So that's not an important part for this next little 3-5 year phase of their life. 5-10 years from now may be a much bigger motivation for them to start paying down that mortgage. So they may trade a mortgage product with a little worse interest rate for something that gives them a lot of flexibility to pay it down quicker, and ultimately that'll end up costing them less money in interest because they're able to prepay that quicker. So it's not as simple as, well, just looking for the very best rate. It's a whole global financial plan. This is the biggest financial investment product that people are going to have their entire lives, for almost everybody. And it's often the least focused on. People get so focused on, well, what mutual fund am I going to pick for what return? And that typically is nowhere near as expensive as their house. And their mortgage, they'll, well, what's cheapest, I'll take that. And oftentimes it's not the very best product for them. So it's important when you're consulting a professional that you go through a whole wants and needs analysis and a whole breakdown of your financial situation and stage of life to figure out, in this 1600, how do we narrow this down to find this is what the best thing is for you.
That's great, man. And something that I don't think a lot of people pay a lot of attention to, but being in the business, I'm sure you can tell when people are getting great service from a mortgage professional, or you're seeing the deal when they're renewing as well. Can we talk about renewing? Like when people come to you and they say, hey, this is what the product I had, it's expiring, on this day. What's that process like?
Depending on we go through a whole wants and needs analysis to make sure that, okay, this next phase of your mortgage is as well planned out as possible. So things like potential career changes. Are you going to be moving? What are your life plans? What are your financial goals? What are your real estate goals? Are you looking at buying rental property? All these things need to be taken into consideration. So it's basically starting fresh with them to make sure what does everything look like now? What fits you the best for this next stage of your life? And then it'll depend on the product that they have right now. It's funny, some people get to the end of their typically 5-year term and they think they can just go wherever they want, but there'll be clauses in their mortgage that they have right now that says they can't really do that, and they may be more stuck with one lender versus another. So again, picking the right mortgage for you in advance will help make sure that renewal period will go as smooth as possible. There'll be some lenders that will try to jack up your rate at renewal. Some lenders will let you go wherever you want to next. Some lenders will try to keep you in-house more so than others. And really that's a consumer satisfaction kind of thing. And so choosing the right lender and product are very important at the outset, so you don't run into any frustrations when it comes to your maturity date and realize, I've limited my options here, and now I don't feel so good about the process anymore.
And this is also the phase where a lot of people will pull some money out of the mortgage to refinance, right?
Yep, and that so for refinancing, it's a completely different loan product versus if we're just going dollar for dollar, bringing your mortgage from one institution to another. There's different products and different pricing that is available too, which often people don't realize. They say, okay, well, I paid down my mortgage to a couple $100,000 and now I want to borrow more. Shouldn't the bank be excited about that? And when they find out they get a worse rate because of that, it's often a little surprising for them. So they're different products, different situations. So that's what we talk about. Okay, well, do you have any renovations that need to be done or want to be done? Or you want to do the kitchen and bathroom. Well, do you have the savings to pay for that? Or is it better off to put that in your mortgage? And here are the pros and cons. And here's the pricing for this. Here's the pricing for that. What's actually going to cost you the least amount of money in the long run? And for some people, cash flow is more important. So they'd rather trade putting it in their mortgage, knowing that, well, this is going to cost me another $100 on my mortgage a month. Or if I put on a line of credit, my line of credit is going to cost me $500 a month. Well, I'd rather have the $400 cash flow a month than having it on a line of credit where I can just pay the whole thing off. Because if you're not going to be paying the whole thing off, it's just going to be sitting there at a higher rate than it's going to be in a mortgage. So oftentimes you're better off sticking it in a more traditional mortgage than on a line of credit for a large debt like that. That's not going to get cleared off anytime soon.
And I mean, interest rates have gone up so much in the last year. It's almost a completely different story from a year ago. I remember we're seeing 2.3, 2.7 for fixed, and then now the latest numbers I believe is like 4.75.
Oh, they're in the fives now.
Wow.
Yeah.
So I mean, this is a completely your borrowing costs have basically doubled in the last year, right?
Well, listen, the interest rate has basically doubled. That's for sure. I mean, the mortgage payments haven't doubled from that time. It doesn't. It's not a linear chart for that. So that's good. The other thing is, I choose to look at it like, if you look at the history of interest rates, we're still at a very good spot. And the stress test has really given me a lot of confidence that knowing that the market can afford this. Basically, everybody has been stress tested at higher rates than currently exist in the market today. So there should be no real affordability crisis for anyone. And while it does, hindsight, everybody's a genius. Everybody would have gone back and bought Apple stock and Google stock and everybody be rich, but that's not how the world works. So when you look at the big picture, paying 5% for your mortgage, historically, it's a great deal.
Yeah.
It's an absolutely great deal, especially when you look at how much places have appreciated over the last little while too. You've gotten such a great return on that. Big picture thinking. The sky's not falling, everything's going to be okay.
Yeah.
And the bottom line is, right now you need a mortgage. Let's find you the best product and rate and service for your immediate needs, and that's all you can do. Make the best deal you can right now.
We see a lot of money changing hands in this business, and there are right ways of doing things and wrong ways of doing things. And you know that when you're going to a trusted professional who's been in business for a long time, you're going to get great service. So, and this man can help you with your mortgage needs. So check the link below for all his information. Scott, thanks for taking the time to explain all this stuff to me.
My pleasure, Eric.
It's a complicated topic, and I'm glad to know that, if I have any questions, I can call you. So
absolutely, anytime.
I appreciate it, man. Thanks a lot.